Welcome to my channel. I'm Scott, and in this video we're going to be talking about accounting scandals. Here's a list of the companies we're going to cover. The first is Waste Management, then Enron, Worldcom, Tyco, Healthsouth, Freddie Mac, AIG, Lehman Brothers, Bernie Madoff, Satyam, and last is Theranos. So Waste Management is currently a publicly traded company. Some companies on this list have gone away after the scandal. Each slide will have a year next to the company's name. The year indicates when the scandal was uncovered. In 1998, Waste Management's new CEO, along with his management team, they discovered the company had reported over $1.7 billion of fake earnings. The SEC convicted the prior CEO along with other top executives. There are not many CEOs that would rat out their current company, but A. Maurice Myers was an honest guy. The SEC fined Waste Management and their auditor, Arthur Andersen, over $7 million. Arthur Andersen seems to be involved in a lot of shady business. They're not around anymore after the Enron scandal. If you invested in a company that lied to you, there's really not much you can do. You're not going to spend $10,000 on a lawyer to get $2,000 back. That's why a class action lawsuit is popular. That means many people could be part of the lawsuit. And the more people part of the lawsuit, the better chance you have as a group to win. The shareholders were able to sue and get nearly $460 million from Waste Management. Enron is one of the most well-known scandals. This was an energy, commodities, and services company in Houston, Texas. And they used lots of accounting loopholes to hide billions of dollars of bad debt while inflating earnings. If you want to lie and deceive investors, you generally do one of two things, or both. You inflate revenue or deflate expenses. That's how you deceive investors. And there's many ways to inflate earnings and many ways to deflate expenses. The result was investors losing $74 billion. That's a lot of money. The stock went from $90 to below $1 within 1 year. The company's CEO and CFO kept billions of dollars of debt off the balance sheet. The more debt you have, the worse your balance sheet looks. So by removing the debt, it makes your balance sheet look better and more appealing to investors. They also pressured Arthur Andersen to ignore the issue, which they shouldn't do, but Arthur Andersen just wanted to collect their fees, so they looked the other way. Kenneth Lay, the CFO, died before going to prison. Jeff Skillings got 24 years in prison for his involvement. And you may think it's no big deal, these rich investors losing money and this guy going to jail, but 20,000 people lost their jobs. And if you're young, if you're in your 20s or 30s, yeah, you could get another job. Some people have been working at Enron for 20 plus years at that point. They had most of their retirement in Enron stock, and now they're gonna have to work till they're 70 or 80 because of these crooks. These corporate scandals affect so many people because oftentimes thousands and thousands of people lose their jobs, which affects them, affects their kids, affects their spouse, and probably affects their health. Worldcom was a telecommunications company based out of Virginia. They inflated assets by $11 billion, making it one of the largest scandals ever. One of their accounting scams was capitalizing expenses instead of expensing them. So if you buy a van for your business, a $50,000 van, you would depreciate that asset over several years. That's called capitalizing. You would put it on your balance sheet, and each year you would remove $5,000 off your balance sheet and put it onto the income statement. So over the next 10 years, you would show $5,000 of expenses each year for that van. Certain assets that have a long, useful life get depreciated so you could smooth out the expenses. But the cost to maintain the van, say you got an oil change, say you bought some new tires, and even your gas, that all gets expensed, so you put it straight into the income statement. But this company was capitalizing most of their expenses. In the long run, it doesn't matter, but in the short term, it's really deceiving. It makes it look like you have a ton of profits when you really don't. And to make matters worse, they were inflating their revenue by making false accounting entries. When a customer buys a product or service from you, your revenue goes up, but they may not pay you for another month or two. That's why I tell people, look at the statement of cash flows. It doesn't matter if the company has a ton of revenue, if they're not getting any cash, then something's wrong. But I have a feeling if you looked at some of these companies' statement of cash flows, they were also fudging those numbers as well. Big companies have internal auditors and external auditors. So Worldcom had accountants that worked at Worldcom, and those were the whistleblowers on this fraud. These internal auditors noticed $3.8 billion in fraudulent accounts. The CEO, Bernie Ebbers, don't trust anybody with the name Bernie, was sentenced to 25 years in prison. And by far the worst thing that results out of these fraudulent activities is all the job losses. 30,000 people lost their jobs, plus $180 billion in investment losses. So lots of people rely on these companies for their retirement, and now that money is gone and those people are in much worse situations. Tyco was a security systems company based out of Princeton, New Jersey. The nefarious CEO and CFO stole $150 million from the company. In addition to that, they inflated the earnings by $500 million. They siphoned off money by using unapproved loans and stock sales. So these were really dirty guys. And they were sentenced to about 25 years in prison. A class action lawsuit forced them to pay $3 billion to investors. Just because you get sued for $3 billion doesn't mean you're gonna ever get the money to pay it. If someone sued you for $1,000 and say the judge ruled in that person's favor, you would just pay $1,000. But if somebody sued you for $1 billion, you would never ever accumulate that much money to pay them. You just have to pay them a few $100s a week for the rest of your life, which sucks, but you would never pay them the entire money they sued you for. Healthsouth, which is now called Encompass Health, that's a publicly traded healthcare company based out of Alabama, and they inflated earnings by $1.8 billion. The SEC wasn't aware of this fraud. They were looking into the CEO who sold $75 million in stock one day before the company posted a huge loss. That was a really bad move to sell the stock one day before posting bad earnings. That puts you right on the radar with the SEC. The CEO got lucky and he was acquitted on all 36 counts of accounting fraud. But he was found guilty for bribing the Alabama governor, and he was sentenced to 7 years in prison. Freddie Mac is a mortgage financing company based out of Virginia. It's a quasi-government agency because it's backed by the US government. It's similar to Ginnie Mae and Fannie Mae. They misstated over $5 billion of earnings. Some people inflate or deflate earnings by mistake. They just don't know what they're doing. But these guys knew what they were doing. They did it on purpose. A bunch of higher ups at the company were fired, and the company was fined $125 million. Since it's a quasi-government agency, these guys were protected. They didn't get any jail time. AIG is a massive insurance company with over 88 million customers. The CEO, Hank Greenberg, did a lot of stock price manipulation. There was an amazing baseball player called Hammer and Hank Greenberg. I think he hit 58 home runs one season, and he should have broke the record at the time, Babe Ruth's 60 home run record. That was the record at the time. But Hank Greenberg was Jewish, and there was a lot of anti-Semitism. So for the last week or two of the season, pitchers were throwing at his head or walking him so he couldn't break Babe Ruth's record. And the SEC did an investigation into Greenberg and uncovered a $4 billion accounting fraud. The company booked loans as revenue, and they forced clients to use certain companies that they had pre-existing payoff agreements with. And the company also strong-armed stock traders to inflate the stock price. They were forced to pay $1.6 billion in fines. They also paid $115 million to a pension fund in Louisiana and $725 million to 3 funds in Ohio. A pension fund invests money for people's retirements. So pension funds can take big risks. They can't invest in things like crypto because people are going to retire and they can't say, oh, sorry, we were going to give you $100,000 for retirement, but now we can only give you $10,000 because we lost all this money in crypto. They can't do that. They have to invest in safe, pretty secure investments. So when they invest in companies like AIG, which they think are safe, but AIG is doing all this fraudulent activity, it's not really fair, it's really deceiving. So these pension funds have a little more pull, so they were able to sue AIG and get some money for the retirees. Next is Lehman Brothers. This is the largest ever bankruptcy in terms of asset size. They were a financial services company based out of New York City. It was one of the largest investment banks in the US at the time. Lots of Ponzi schemes and scandals work fine until the money starts to dry up. That great quote by Warren Buffett, "Only when the tide goes out do you discover who's swimming naked. Only when the money dries up do you discover who's doing fraud." I remember the 2008 financial crisis really well. And I remember when Lehman Brothers went bankrupt and Bear Stearns almost went bankrupt. They got acquired by JP Morgan. And Lehman Brothers hid $50 billion in loans. They disguised these loans as sales using counting loopholes. They sold toxic assets to banks in the Cayman Islands on a short-term basis. And the idea is they would buy those assets back at some point in the future. So this gave the impression the company had $50 billion more in cash and $50 billion less in toxic assets. It's like if you go to a bank and you want to get a loan for a home that's $1 million, and let's just say you only have $50,000 in cash in the bank and no other assets. When you go to the bank, you just add a zero and you say you have $500,000 in cash. So the bank gives you that loan. Say you end up defaulting on the mortgage loan and the bank says, "Well, pay us the money, you have $500,000 in cash." And then you tell them, "Well, actually it's $50,000 in cash." Well, the bank wouldn't have given you that loan if they knew you had $50,000 in cash. Now the bank is out all that money and they're probably going to sue you. So it's really messed up that these companies do this kind of fraud. They deceive investors by showing a picture of a company that looks a certain way, but when times get tough, you realize they were showing you a picture that was fake. They painted a much rosy picture. They showed you a lot more revenue than they really have, a lot less expenses than they really have. It's kind of like a bait and switch. And next is the infamous Bernie Madoff. He's a former stockbroker that orchestrated the largest Ponzi scheme ever. And this scheme was discovered because of the 2008 Great Recession. He tricked investors out of $65 billion. Madoff and his accountant and his second in command were all convicted of the charges filed against him. He's serving the largest prison sentence for white-collar criminal, 150 years, and he has to pay back $170 billion in restitution, which he'll never be able to ever pay back, especially that he's in jail. Satyam, the only non-US company on this list, they're an Indian IT services and back-office accounting firm. They're based out of Hyderabad, India. They inflated revenue by $1.5 billion. There was an investigation by India's Central Business of Investigation that the company falsified revenues, margins, and cash balances. The founder and chairman, Ramalinga Raju, he admitted to the fraud to his directors, but he never really got into any trouble because India's Central Bureau of Investigation didn't pursue the issue. Theranos was a healthcare startup in Palo Alto. It was once valued at $10 billion. The company's CEO and founder, Elizabeth Holmes, said her technology would revolutionize the blood testing industry. In order to perform certain medical tests, you have to give a good amount of blood. And the way that blood is taken is with a needle, usually in your arm. There are lots of people who don't feel comfortable with a needle in their arm, and there's also lots of people that aren't comfortable giving out that much blood. But Elizabeth Holmes said with just a prick of the finger and just a few drops of blood, she could do the same thing as what the medical industry has been doing for many, many decades. And the company raised over $700 million from venture capitalists and private investors. And this great innovative technology never worked. So people invested $750 million without even seeing proof. Holmes was barred from serving as an officer or director of a public company for 10 years. And just last week, she received a prison sentence of 11 years. In 2016, Theranos started shutting down clinical labs and wellness centers, and finally ceasing operations in 2018. In 2015, Holmes became the first self-made female billionaire. Her net worth peaked at $4.5 billion, and now she's currently at nothing. So crime doesn't pay. I hope you learned something new in this video. Please subscribe, leave a like, comment. Thanks for watching.